What if passing a prop firm challenge didn't require trading genius? You keep blowing accounts, and it's not your fault. Evaluation fees drain your account. Repeated failures crush your confidence. You're stuck in the same cycle over and over again. Forget what your favorite guru told you. This is educational only, not a guarantee. Results come from discipline, not magic. By the end of this section, you'll spot the exact trap that kills 90% of challenge takers. Most traders fail prop firm evaluations not from bad strategy but from poor math. They overtrade. They overleverage. They blow up. You feel the rush, chasing the profit target while drawdown limits flash ignored. You take a painful loss, then 2 weeks later you make the exact same mistake. It's not your fault. Your method never taught you to respect the numbers. The data is brutal. 90% fail because they don't calculate risk before they click. They treat the challenge like a sprint, but it's a marathon of discipline. But here's the twist. The rules they hate are actually their best friend. The very boundaries you curse are the only thing that can save you from yourself. Stillness creates clarity. Clarity creates memory. The two killers, max daily loss and max total drawdown. One moment of tilt, one oversized revenge trade and you're out. The numbers don't care about your ego. A prop firm challenge is like walking a tightrope. The math is your safety net. Without it, you're a gust of wind from disaster. You chase the 10% target while ignoring the 2% that can end you. The discipline is hard. The math is simple. Stillness creates clarity. Clarity creates memory. Memory creates discipline. When you internalize the numbers, the challenge becomes a calculation, not a gamble. Question: what if I told you the profit target is the easy part? Most traders obsess over the target while the real war is against the drawdown. They see the finish line and ignore the cliff. The drawdown is the real test always. Deadlines tighten the screws. That countdown clock whispers, you're running out of time. So you force trades, you chase. You revenge trade after a loss, desperately trying to claw back gains. The pressure turns a clear strategy into frantic chaos. But there's a number most traders never calculate, and it determines everything. That number is your risk of ruin. It tells you how likely you are to blow up based on your win rate, risk per trade, and drawdown. The deadline creates an illusion of scarcity. You feel like every second not in a trade is wasted. This emotional hijacking is the real enemy. The number, your risk of ruin, cuts through the noise. Calculate it once and you see the path clearly. Imagine knowing before you even start whether you'll pass. No more hope. Passing is a math equation. The firms know your weaknesses. They built the challenge to exploit them. They count on your boredom, your greed, your fear. They know you'll break the rules when the pressure peaks, but now you know the secret. The rules are a mirror showing you where you break. Once you see the matrix, you can play the game on your terms. The math is the key. It's not about predicting the market, it's about predicting your own behavior. Stillness creates clarity. Clarity creates memory. Memory creates discipline. With the right numbers, you become the one who passes while others fail. So how do we flip the math in our favor? That's exactly what's coming. We'll build a system that treats the challenge like a solved equation. No more hope, just math. The game is about to change. I'm about to turn confusing rules into simple numbers you'll never forget. Most prop firms use the same structure: a profit target, a max daily loss, and a max total drawdown. Typically, it's an 8% profit target, a 5% daily loss limit, and a 10% overall drawdown. 3 numbers. That's the whole game. Your daily loss limit means if you lose 5% in a day, you stop. No exceptions. Your total drawdown means from your highest balance you can't lose more than 10%. Cross it and you fail. The profit target is the finish line, hit it and you win. Now break it down. If you risk 1% per trade, you can take 5 losses in a day before breaching the daily limit. You have 10 losses in a row before completely blowing the account. But these numbers tell a hidden story. There's a buffer zone between your profit target and drawdown that most traders ignore. Think of your drawdown as a health bar in a video game. You wouldn't waste your health on reckless moves, so don't waste your drawdown. The buffer zone is the space where you can take calculated risks without fatally wounding your account. What if your account size doesn't matter as much as you think? Percentages scale identically across all account sizes. Whether you're trading a 10K, 50K, or 200K account, the rules remain the same. 5% daily loss, 10% overall drawdown, 8 to 10% profit target. Dollar amounts change, but the risk percentages are constant. Your focus should be on the math, not the money. This understanding turns emotion into calculation. See a $100,000 account. Picture having a roadmap before you place a single trade. When you understand the rules as pure math, emotion vanishes. You know exactly how many losses you can afford. You know exactly how many wins you need. There's no guesswork, no hoping, just numbers. This clarity removes fear. You stop checking your P&L every second. You focus on execution, not outcomes. Stillness creates clarity. Clarity creates memory. Memory creates discipline. The numbers become your anchor. You'll no longer chase losing trades or cut winners short. You'll follow the math because it's predictable. The emotional roller coaster, the fear, greed, revenge all dissolve when you see the game as equations. Your only job is to follow the roadmap. That's the freedom of trading with math. Soon, you'll have a formula that does all the thinking for you. No more second guessing. The math decides. You execute. You're about to see the exact formula that tells you how many trades you're allowed, how much to risk, and exactly when to stop. This formula works on any account size, from $10K to $200K. It turns the prop firm challenge into a probability game you can win. No more guessing, no more anxiety, just a clear step-by-step plan. In the next part, I'll reveal the magic ratio between your risk per trade, your drawdown, and your profit target. You'll learn to calculate your buffer zone in seconds. You'll understand why 90% of traders fail, and how you can become one of the 10% who pass. Get ready to master the numbers. Once you see them, you'll never look at a challenge the same way again. The math is your weapon. Wield it, and the challenge is always yours. You take a painful loss, then 2 weeks later you make the exact same mistake. It's not your fault, it's the method. You've been trading without a system. This is the formula that does the heavy lifting for you. Profit target divided by risk per trade equals winning trades needed. Plug in, calculate, execute. Say you need an 8% target, risking 1% per trade with a 2-1 reward ratio. That's just 4 winning trades. But wait, there's a second formula that protects you. Calculate your required win rate using your risk-reward ratio. With a 2-1 reward, you only need a 40% win rate to pass. Losing more than you win can still lead to profit. The formula proves it. Now here's the part that feels almost like cheating. Combine both formulas to find your optimal risk per trade percentage. Most traders risk too much, and the math proves it. You've been bleeding out with 2% risk, when 0.5% keeps you safer. Stillness creates clarity. Clarity creates memory. Memory creates discipline. The numbers don't lie. Imagine reverse engineering the entire challenge before day one. You take your profit target, your max drawdown, your reward ratio, and you solve for risk. You know exactly how many trades you need, how many losses you can survive, and the minimum win rate required. It's a roadmap. No more revenge trading, no more hesitation. You build a full plan, daily risk limit, trade frequency, and a checklist that removes emotion. You're no longer reacting to the market, you're executing a pre-calculated mission. The next section shows you how to apply this in real time, so you're not just passing a challenge, you're cementing a habit. The math is your edge. The discipline is your profit, and it all starts with a simple equation. Let's watch this math come alive with real scenarios. You've got an aggressive trader risking 3% per trade. A few losses and the numbers turn brutal. One bad streak. Game over. The conservative risking 0.5% protects capital but moves like molasses. You'll never feel momentum. Both extremes fail you. But what's the sweet spot? The math reveals it. A 10-trade losing streak with 1% risk still leaves you standing if you've built the buffer. Without it, you're wiped. Run the numbers. A 50% win rate can produce strings of 5, 6, 7 losses. Your math must survive that abyss. I've watched a balanced account breathe through a month where 8 out of 12 trades were red, still net positive. The method, not you. Question: how many trades should you actually take per day? Most of you bleed out by overtrading. Calculate optimal frequency. 2 to 3 high-probability setups hit your targets without exhaustion. There's a daily limit your math should impose on you. Now imagine doing this calculation in 60 seconds before every session. It becomes automatic armor. Master this one calculation, and you'll never blow another challenge from one trade. Position sizing is the math that saves accounts. The formula is brutally simple. Account risk in dollars divided by stop loss in points times value per point. Wrong size, instant failure. Right size, survival. You risk $100 on a trade. Your stop is 20 pips away. Each pip moves your P and L by $10 per standard lot. Do the math. 100 divided by 20 times 10 equals 0.5 lots. Exactly 0.50.5 lots. That's the only correct size. Not more, not less. The market doesn't care about your confidence. Only the math protects you. Stillness creates clarity. Clarity creates memory. Memory creates discipline. Discipline locks it in. This formula is your anchor. Volatility changes the game. That calculation must adapt. You must adapt. But here's the hidden danger nobody warns you about. What if your stop loss is secretly controlling your fate? It does. Your stop distance and your lot size are tied by an invisible string. Pull one, the other moves. A tighter stop allows a larger lot size, tempting, but it flips the math. With the same dollar risk, a 10-pip stop doubles your position size. You now command twice the leverage. Feels like power. It's really a trap. A tiny wiggle stops you out. Your wider stop with smaller size gave you room to breathe. Smaller stop, bigger size, no room. Price needs to barely twitch and you're gone. The inverse is law. Stop loss shrinks, lot size swells. Keep risk constant and the relationship is unbreakable. Here's a twist. Smaller stops aren't always safer. Smaller stops aren't always safer. They seduce you with bigger lot sizes and faster wins, but they come with a hidden cost: noise. A 10-pip stop gets hit by random vibration. You get stopped out before the real move. You re-enter, get stopped again. Death by 1,000 cuts. A 30-pip stop with a smaller size absorbs the chaos. The trade breathes. You stay in the game. The sweet spot exists where the math balances protection and opportunity. There's a number that balances both, and the math finds it. It's not a guess. It's a calculation rooted in the asset's true range. Measure the average movement, set your stop accordingly, and let the formula dictate your size. The guesswork dies. Imagine never having to guess your lot size again. Imagine never having to guess again. You can live that reality. Here's your repeatable checklist. Step 1. Define your dollar risk, never more than 1% of your account. Step 2. Measure the current ATR on your time frame. Multiply it by a factor that fits your strategy. 1.5 or 2 is common. That's your stop loss distance. Step 3. Use the position size formula. Account risk divided by stop distance in points times point value. That spits out your exact lot size. No emotion, no debate. Step 4, place the trade and walk away. The math has spoken. Your only job is execution. This checklist turns chaos into ritual. Tomorrow we lock in daily loss limits, so a bad day never turns into a dead account. The math never stops protecting you. Hit it once. You're done. That's your daily loss limit. It's not a suggestion. It's the most dangerous rule you have, and it exists because the market doesn't care about your feelings. Before you even open your chart, calculate that number. Know exactly where the line is. When you're deep in a trade, your brain will lie to you. The math will not. Write it down. Stare at it. This single number is the difference between logging off to fight another day and burning your account to the ground. You don't need to win every battle, you just need to survive the war. The rule is simple. You reach this number, the screen goes black. No debate, no revenge, no exceptions. The math keeps you safe. But here's the psychological trap built into this rule. Your mind sees the limit not as a hard wall, but as a target. You take a loss, and you're sitting at 80% of your limit. Your brain whispers, you still have 20% left. Use it, get back to even. This is the trap. You are rationalizing a violation. You treat the remaining risk as a coupon for revenge trading. It isn't. It's the emergency brake. You didn't build the limit to spend it all. You built it to protect yourself from the version of you that emerges when you're bleeding. That version is a terrible trader. When you feel the urge to use up the rest of your risk, you're no longer waiting for a setup. You're just chasing a feeling. The limit isn't a budget, it's a shield. Hold it up. Think of the daily limit as a circuit breaker. When the power surges, the breaker trips to stop the whole house from catching fire. You don't stand in the dark, staring at the fuse box, screaming, just one more volt. You accept the silence. You let it trip. Going dark for the day is the smartest move you can make. If you force the breaker back on, you fry the wires. You blow the account. The market surge is over for you. Let the silence save you. Stillness creates clarity. Clarity creates memory. Memory creates discipline. Taking a forced break isn't weakness. It's a high-level skill. You are not sitting out. You are actively preventing your own destruction. Let the circuit trip. Embrace the dark. You'll see the chart clearer tomorrow. Question: how many trades before you should walk away? Not losses, trades. If you know your limit and you know your risk per trade, the math is painfully obvious, yet most ignore it. If you risk $50 per trade and your daily loss limit is $150, you don't have unlimited bullets. You have exactly 3. This forces the 3-strike rule. 3 swings and you're out. No 4th attempt. No sizing up. The math doesn't allow for hope. Calculate your maximum trades before the day starts. If you hit your loss limit but didn't use all your strikes, the day still ends. It's not about swinging until you strike out. It's about stopping when the pain threshold is hit. Knowing you only have 2 or 3 chances changes your psychology. You stop throwing random setups. You hunt. You wait. You become a sniper, not a machine gunner. Limited bullets create elite focus. The rule is simple. No single day can be more than X% of your total profit. Usually that's around 30%. You hit a home run, feel the rush, and think you're a shoo-in for funding. Then the email comes, violation. One big day can disqualify you. One peak of euphoria erases weeks of work. It's not a judgment on your skill, it's a math filter. You're left wondering why your best effort pushed you out the door. Let's break it down. If your profit target is $3,000 and the consistency rule caps any single day at 30%, your maximum allowed profit per day is $900. Exceed that, and you're out. That means a single day of $910 on a $3,000 target breaks you. You didn't trade worse. You traded too well for one isolated moment. The math doesn't care about your intention. It cares about the distribution. Pacing becomes your only defense. You learn to hunt for base hits, not grand slams. The market becomes a place of quiet accumulation, not violent swings. Consistency rules are like portion control for your gains. You wouldn't eat a week's worth of food in one sitting and expect to feel healthy. Why would you binge profits and expect your account to survive? It's a pacing mechanism that trains your mind to see profit as a slow, steady breath. Here's how you do it. Take your total profit target and multiply it by the consistency cap. If the cap is 25% and the target is $2,000, your daily ceiling is $500. Now, set a floor. Aim for 50 to 70% of that ceiling. Your target daily profit range becomes $250 to $500. You exit when you're in the green zone, not when the chart tells you to. You become a thermostat, not a thermometer. You set the temperature. Here's how to make the math stick when emotions scream at you. You take a painful loss, then 2 weeks later you make the exact same mistake. It's not your fault, it's the method. When pressure hits, you abandon the numbers because your brain seeks relief, not accuracy. Fear lies. Math doesn't. Fear lies about the outcome, but the math knows the edge will play out over time. Stillness creates clarity. Clarity creates memory. Memory creates discipline. You must follow the calculations even during a losing streak, because that's the only path through the noise. But here's the mental shift that changes everything. You're not a fortune teller, you're a calculator with patience. Trading isn't about predicting markets, it's about executing a math plan. Each trade is a data point, not a verdict. The moment you stop predicting and start calculating, the weight lifts. You don't need to be right, you need to be disciplined. Stillness creates clarity. Clarity creates memory. Memory creates discipline. When you trust the math, you trade the process, not the hope. The numbers don't care about your feelings, and that's their greatest gift. Question: what's the real reason you break your own rules? After a win, overconfidence whispers that you can outsmart the system. After a loss, fear screams to avoid more pain. Both are traps that pull you away from the math. You need mental anchors, simple routines that lock you back into the calculations. Before each session, repeat, fear lies, math doesn't. Write your numbers down. See the edge in ink. Stillness creates clarity. Clarity creates memory. Memory creates discipline. The discipline to follow your plan, win or lose, is the only edge that matters. Here's a twist. Boredom is the real enemy, not risk. Disciplined math trading feels uneventful. No drama, no heroic calls, just steady execution. Your brain craves excitement, so it invents reasons to deviate. But every unnecessary trade is a leak in the bucket. You must embrace the quiet. Stillness creates clarity. Clarity creates memory. Memory creates discipline. There's one daily habit that locks in discipline, revealed next. It's the simple practice of logging not just the outcome, but the emotional state against the math. That gap shows exactly where you break. Imagine trading with the calm of a machine. No flinch, no euphoria, just the numbers. That's what journaling and review tied to the numbers builds. After each day, record. Did I follow the math? Where did emotion override logic? This review isn't punishment, it's calibration. Stillness creates clarity. Clarity creates memory. Memory creates discipline. Over time, you rewire your responses. The math becomes not just a tool, but your identity. And once that identity is set, discipline stops being a fight and starts being your default. That's the foundation for everything that follows. You started this journey chasing wins, driven by emotion. You took losses personally. You revenge traded. But now you see the truth. Trading isn't about prediction. It's about probability. 3 numbers, 2 formulas. 1 disciplined mind. Remember the expected value formula. It turns gut feelings into cold, hard math. Risk of ruin showed you why 1% risk keeps you in the game. And the Kelly criterion guided your position sizing. These aren't just equations. They're your shield against the market's chaos. When emotion screams, the math whispers calm. Stillness creates clarity. Clarity creates memory. Memory creates discipline. You've moved from guessing to grinding, from hoping to knowing. This is the edge. The numbers don't lie. And now they're yours, so take a breath. Let that sink in. The transformation is complete, but here's the real secret. This video led to this. Breathe it in. But here's the most important takeaway of all. Passing your challenge isn't a one-time miracle. It's repeatable. When you trust the math delivers. Every time you follow the formula, you stack the odds in your favor. You stop chasing and start calculating. The math is your map. Now you just have to walk the path. Each step you take with discipline brings you closer to that funded account. No more emotional decisions. No more doubt. Just execution. And here's the question that separates the funded from the failed. Why do so many traders blow up when they know the rules? Think about it. You've got the tools. You've done the work. But in the moment, old habits creep in. Is it intelligence? No, it's psychology, it's discipline, and that's where you win. The path is clear. Each day you calculate, you execute, you review. That's the cycle. It becomes automatic. When you trust the process, the funded account isn't far away. Imagine getting that email. Congratulations, you're funded. The weight lifts. The work pays off. You didn't get lucky. You earned it through discipline. Every calculated risk, every controlled trade led to this moment. The math validated your journey, and you know you can do it again, because it's not magic, it's method. So tonight, run your numbers, open your journal, build your plan for tomorrow, start right now. The funded traders aren't different from you. They just stuck to the math. They embraced the boring. They turned the system into habit. And now it's your turn. Stop waiting for the perfect setup. The perfect setup is the one you plan, trust it, act on it. If you're ready to commit, type trading in the comments right now. Let me hold you to it. This is your accountability. Like and subscribe so you don't miss the tools that will keep you funded. Check the description for 2 free gifts. The 15-step checklist to use before every trade and the risk management calculator to never risk too much again. These automate the exact math from this video. They will skyrocket your chances of getting funded. The journey starts when you click the link and run your numbers tonight. See you in the funded account circle. Trade with discipline. Trust the math. You have the map. You have the method. It's time to walk the path. Every great trader started with a single calculated step. Take yours tonight. The math is on your side. Now go.